So here's the Fed's dilemma, and it's playing out in real time. So Jay Powell gave, I lost count, 7 or 8 speeches, and he said the same thing every time. He said, inflation is job one. We're on a path to raise interest rates. We're not going to quit until inflation is under control. Now, there's a little wiggle room around that. Their target is 2. They actually look at personal consumption expenditure year over year, core. That's their metric. There are 15 ways to measure inflation, but that's the one they like. But even that is still over close to 5. It's a long way from 2. That's the point. You're trying to get to 2. They're a long way from 2.
Welcome to the New Finance Channel. Dive deep into the intricate world of finance with insights from experts like Jim Rickards, as we dissect the decisions of figures like Paul Volcker and Jay Powell, their impacts on inflation, and the direction of the Federal Reserve. Join us as we unravel Wall Street sentiments, historical blunders, and the complexities of quantitative tightening. Whether you're a seasoned professional or new to finance, this channel offers perspectives that challenge the status quo. Hit that subscribe button and let's embark on this financial journey together.
But there's something called the terminal rate. What's the terminal rate? Well, no one knows the number. I don't know because Jay Powell doesn't know. So we're all estimating. But the terminal rate, it's a rate that's high enough to bring down inflation on its own without further rate hikes. We can stop here and confident that inflation is going to come down without doing more. Because the conundrum is, okay, they've been raising rates since March 2022. Monetary policy works with a lag. Inflation peaked in July 2022, and it has been coming down ever since. Some months were, January was hot compared to December, but the trend has been down. So they're raising rates and inflation is coming down. So that's good. But here's what they don't know. Was inflation coming down because they were raising rates? Or had they already hit the terminal rate and they just didn't know it? Because Wall Street was like, no, you've hit the terminal rate. Stop, please stop. You got this under control. The Fed doesn't believe that. One of the greatest blunders in monetary policy was Paul Volcker in 1980, who had started raising rates in 1979, and inflation was coming down. But then in 1980, we had a very sharp recession that had nothing to do with monetary policy. It wasn't caused by Paul Volcker. Jimmy Carter put a cap on credit card interest, and banks stopped issuing credit cards. So, well, that'll sink the economy. And then so Volcker reacted to that by lowering interest rates 7 percentage points, not 70 basis points, 7 percentage points, because we're in a recession, right? That's what Feds do. The Fed chairs do. But because it was a regulatory blunder, they fixed it and the economy came roaring back. And then inflation really took off, worse than when Volcker got in 79 and early 1980.
Jim Rickards delves deeply into the current dilemma faced by the Federal Reserve. As described, Chairman Jay Powell has made numerous speeches, all consistently emphasizing that tackling inflation is their top priority. The Fed has been steadfast in its commitment to raising interest rates until inflation is firmly under control. While they have a target inflation rate of 2%, they measure this based on the personal consumption expenditure year-over-year core. Though there are numerous methods to gauge inflation, this is their preferred metric, and currently, it stands closer to 5%. Which is quite distant from their goal. Rickards brings up the notion of the terminal rate, an interest rate deemed sufficiently high to curtail inflation without the need for additional hikes. It's a speculative figure, as even Powell doesn't have a clear number in mind. The complexity arises from the fact that although the Fed began hiking rates in March 2022, and inflation, which peaked in July 2022, has been on a decline. It's unclear if the decline is a direct result of these hikes, or if the terminal rate has been inadvertently achieved. Wall Street suggests that the terminal rate might have been reached, urging the Fed to stop further rate hikes. Rickards references a historical blunder to emphasize his point. In the 1980s, Paul Volcker started raising rates, and inflation was dropping. However, a sharp recession in 1980, triggered not by monetary policy but by President Jimmy Carter's cap on credit card interest rates, led banks to stop issuing credit cards, effectively stalling the economy. Volcker's reaction was to significantly reduce interest rates, but when the initial regulatory issue was corrected, inflation surged even higher than before. This serves as a cautionary tale for the current scenario.
So Volcker had to take rates to 20% to get inflation under control the second time after cutting them in 1980. And that's called the Volcker mistake or the Volcker blunder. And Volcker himself, I spoke to him, he said, yeah, that was a mistake, that I should have stuck to my program, not worried about the economy and unemployment, but just got inflation under control. But when he threw in the towel prematurely, the inflation went to the moon. Jay Powell doesn't want to be that guy. Jay Powell knows that episode as well as I do. And he doesn't want to be the guy who throws in the towel early and then inflation just goes to the moon and then he has to take interest rates to 15% or something ridiculous. So Wall Street's saying, you're already there, mission accomplished. Powell's saying, not so fast. They told Volcker that, and he cut rates, and it was an enormous mistake. So Powell's not going to be that guy. So what is the terminal rate today? I would say 5.5, because we had a lot of hot data, unemployment down, job creation up, retail sales up, not to the moon, but these are the opposite of what Powell is looking for. So he's had no confirmation that inflation is coming down on its own. He's had a lot of data that says inflation may be getting ready to take off again. So you got to say the terminal rate went from 5.25 to 5.5, maybe more. And Powell always said, I don't care if there's a recession. I don't care if there's unemployment, because the long-term costs of inflation are going to be much greater than those short-term problems. We got to suffer through that to get a bigger problem under control.
In reflecting on the financial decisions of the past, Jim Rickards discussed Paul Volcker's decision to elevate interest rates to a staggering 20% to combat inflation after initially reducing them in 1980. This act, often referred to as the Volcker mistake or the Volcker blunder, was acknowledged by Volcker himself when Rickards had a conversation with him. Volcker expressed regret, mentioning he should have stayed committed to controlling inflation rather than becoming preoccupied with the economy and unemployment concerns. However, his premature softening led to surging inflation. Current Federal Reserve Chairman Jay Powell is intent on not replicating this past mistake. He's acutely aware of this historical event, and the lessons drawn from it influence his actions today. There's a sentiment on Wall Street that Powell has already reached the desired interest rate level to control inflation, but Powell is hesitant to declare this as a victory too early. Rickards speculates that the so-called terminal rate might now be around 5.5%, given recent robust economic data, such as decreased unemployment, enhanced job creation, and augmented retail sales. Contrarily, this positive data isn't necessarily congruent with the signs Powell wants to witness, indicating inflation control. In fact, the data might suggest that inflation is ready to escalate once more.
He thinks of inflation. He said this many, many times. Now, along comes Silicon Valley Bank, okay? But by the way, in addition to raising rates, don't forget QT, quantitative tightening. They were shrinking their balance sheet. It's very hard to estimate the monetary impact of shrinking the balance sheet, but the best estimate is for every $1 trillion you take it down, it's probably equal to a 1 percentage point hike in the Fed funds rate. So the tightening has been more than just taking Fed funds rate up. You also have to take into account QT. Now let's go back to the bond guarantee and bailing out the entire banking system. The Fed proceeded to guarantee every deposit and every bank in the entire U.S. banking system. We were talking, $6 or $7 trillion of assets. And the way they did it was a lot of other banks, big ones and small ones, at least the big ones had good risk management, but a lot of small and medium-sized banks, they had the same problem Silicon Valley Bank had. Maybe the depositors weren't walking out the door, or maybe they weren't funding tech startups, but they had underwater bonds and overnight deposits and were facing the same thing. So the Fed said, okay, all you banks, if you send us your bonds, we'll give you cash. Okay, that's just a normal discount operation, but we'll give you cash equivalent to the par value. So again, remember the market value is like 80 cents on the dollar, but the Fed says we'll give you 100 cents on the dollar. So now you ship your bonds to the Fed. They give you not 100%, which is like low collateral, but they give you 120%. So the banks are shipping in bonds that are worth 80 cents on the dollar. Why wouldn't you do that? I'm like, hey, Fed, if you want to give me a low interest rate bridge loan with 80% down, I'll take all you got. So now the banks are going to do that. And by the way, because it's structured kind of like a repurchase agreement, there's no sale. So they don't have to market to market. If you sold it to a third party, a dealer, you'd have to take the loss. But now they don't have to take the loss. So they're shipping in billions, potentially $1 trillion or more of these bonds. They're not getting 80, 90 cents on the dollar, which is what they're worth. They're getting 100 cents on the dollar, which was the original purchase price. They don't have to take the loss, and they're getting cash. Why wouldn't you do that all day long? So in effect, they bailed out the entire banking system to the tune of trillions of dollars. They just blew up the $250,000 limit. Forget that. I mean, I know what the statute says, but they threw that out the window. And the moral hazard, the economic consequences, the repercussions of this are kind of unimaginable. I mean, I can sketch them. I can talk about them. To hear Janet Yellen say it's not a bailout. Are you kidding me? This is the biggest bailout in history. And I negotiated the LTCM bailout. I lived through that. That was $1 trillion of derivatives. Through 2008, 2020, the pandemic. I go back to 1994, the Mexican tequila crisis. I've lived through all of these and been more or less directly involved in all of them. And this is orders of magnitude greater in terms of what's being bailed out.
Powell's perspective on inflation is clear. He's more concerned about its long-term consequences rather than short-term challenges such as recessions or unemployment. As Rickards explained, Powell's commitment to containing inflation is unwavering, often referencing an instance with Silicon Valley Bank as a testament to this dedication. Moreover, Rickards touched upon the concept of quantitative tightening, QT. While the Federal Reserve has been trying to manage inflation through interest rate adjustments, they've also been actively reducing their balance sheet. According to estimates, for every $1 trillion the balance sheet is shrunk, it's approximately equivalent to a 1 percentage point hike in the Federal Reserve's benchmark interest rate. A significant aspect that Rickards highlighted is the Federal Reserve's action to guarantee all deposits across U.S. banks, a move encompassing $6 to $7 trillion in assets. While large banks generally had sound risk management practices in place, numerous smaller to medium-sized banks grappled with the same issues Silicon Valley Bank faced, such as bonds valued below their market prices and vulnerable overnight deposits. To address this, the Federal Reserve offered a lifeline to these banks. They could send in their bonds in exchange for cash, at a rate even higher than the bond's current market value. The banks, taking advantage of this opportunity, began sending bonds valued at 80 cents on the dollar, but received higher returns from the Fed. This operation, designed much like a repurchase agreement, effectively meant banks didn't need to recognize losses on these bonds.
Doesn't that mean that a lot of banks will be sending the bonds to the Fed and getting cash? Yeah, that's exactly what it means. Well, where's the cash come from? You got to print it. So on the one hand, we're doing quantitative tightening by letting bonds mature and not reinvesting. But on the other hand, you just send an open invitation, open party, house party to every bank in the country saying, send us your bonds and we'll give you cash. Not only that, but 100 cents on the dollar, even if they're worth 80. So you're going to have potentially trillions of dollars of new money being printed at a time when the Fed's trying to get inflation under control and they were trying to shrink the balance sheet. They're going to be expanding the balance sheet. So, I mean, there's no way out. There's no good way out of this. You can pause. I don't think they will, but you could pause and not raise rates, right? And implicitly saying we're not going to raise rates for the foreseeable future because we got all these losses in the banks. Okay, inflation goes to the moon. I promise you it'll just take off like a rocket. Or you can raise interest rates 25 basis points and we'll continue this war on inflation, but you're just going to increase the bond losses in the banks and make them send you more bonds and get more cash. Or the third thing is just take away the umbrella and let all these banks fail. I mean, it's like name your poison. Name your poison. You can have runaway inflation, severe acute banking crisis, or basically a lot more, as I say, a lot more bank failures and a severe recession because you're going to keep raising rates. There are three choices, but none of them are good.
And that's it for this video. Let us know your thoughts in the comments down below. Thanks for watching till the end. Before you go, make sure to like and subscribe and click the notification bell to trigger YouTube's algorithm and see more of our videos on your homepage. Thanks for watching and see you next time for more interesting videos like this.